Good morning, options traders. Welcome back, everyone. Happy Monday. And I've got a really cool thought question for everyone. Do options decay faster over time? And I want you to think about that for just a moment. And I already know the answer because I've asked this thousands of times in classes, and the answer is always the same. Well, of course they do. As we get closer to expiration, they start decaying faster, and that becomes a risk. Well, we're going to find out it's actually one of the biggest misperceptions in all of options trading, and it causes traders to make very bad decisions. So let's go find out more about this mysterious question. Do options decay faster over time? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So the time decay curve, everybody's used to seeing this. This is for an at-the-money option, and I've got it drawn for 100 days to expiration. We have time moving this way towards zero, and we can see that if I make the options price $1, or let's call it 100%, whatever the price is, we start sliding down, relatively speaking, flatter slope, but then as we get closer to expiration, we start to see it accelerate, becoming almost vertical over here, real close to expiration. Now, as I've talked about before, because of the square root pricing relationship, when you have 25% of the time remaining, which would be 25 days out of 100, we take the square root of 0.25, we get a half. And that means that half of the option's price will remain. And we can see it right here. We trace a line up to the black curve, and there it is, 50 cents. So again, or 50%, whatever this price is, it would be worth half that when 25% of the time remains. So if this were a $10 option, with 100 days at the beginning, we've got 25 days left, it would be worth 5 at that moment. And we can see that the time decay curve is relatively flat over here. People aren't real concerned about this loss of option premium, the extrinsic value. But as we start getting closer to expiration, we start going off of this very steep curve. And this is where a lot of people think that the benefit of selling options comes in, sell them short dated so you capture that steep curve, or maybe I should exit my position because we're about to enter the steep part of the curve. And they have all kinds of crazy ideas, good and bad, about this steep part of the curve. Well, is it really there, or is it just an illusion? So time decay acceleration, or that apparent acceleration, isn't due to time moving faster. That's what a lot of people think when they start seeing this curve. It's going to start moving faster, or as if we're moving faster through time. It's not. In fact, don't think of theta as an increasing danger. What we're going to find out is that it's the same curve, what appears to be this gentle curve and then approaching this very sharp curve. It's actually the same curve. We're just looking at it through a warped lens. And that's what's causing the curvature. What really happens is that each unit of volatility time costs the same percentage of extrinsic value. And that's a hard thing to understand, and it's actually a hard thing to show. But what I'm going to try to do is to show that this idea of fast theta is really a compression of the same curve into smaller time intervals. It's just an illusion because we really have the wrong scales on our graph. So when you have things in different scales, again, you get kind of warped perceptions. Let me show you one here a little bit from geometry. And let's say that we have this horizontal line right here, and we've got a light at the top. All right, so we're going to shine this light down, and it's going to cast a shadow. Now, can you see that the length of this black line would be exactly equal to the length of the shadow, right? Because the light is straight up here at the top, light traveling in straight lines, the shadow is exactly equal to that black line. But now let's say that I pick this black line up and I'm going to move it through time equally spaced and equally fast. Now, I probably didn't draw that to scale, but that's what's happening. Each step going from the black to the green is the same angle, kind of the same step size, and it takes the same time. Going from the green to the blue to the light blue, it's just a constant sweeping motion. But watch what happens to the shadow. So as the line, black line, moves up here to the green, what happens? The length of that green line appears to now be a little shorter. So for everybody who's had geometry, we'll remember this as cosine, but I'm going to try to avoid the mathematical terms. But visually, you can see that green line is the same length as the black line. It's just been picked up. And so the shadow appears to shrink a little bit. Doesn't appear to make a very big difference. But now remember, it's moving at the same speed. So as I move from the green to the blue, what happens? See, now I've got a bigger area that's going to shrink. And so now the shadow appears to be shrinking faster. As we move from the blue to the light blue, what happens? Remember, the black line is moving through all of these at the same speed. You shouldn't say it's moving faster. It's the same speed, but what does it look like when we cast it onto a straight line? So again, it's the wrong scale. And that's what happens. So here, now look at the size of that shadow. Now it looks like it really started to bleed away or to fade away, even though it really didn't. We move to the purple. What happens now? Now look at how quickly that shadow moves. We move to this gold. Look at how much bigger these intervals are getting. You can see it over here, fairly small interval. These intervals are getting wider. Think of it like maybe dropping a bowling ball off of a building. From physics, we know that the acceleration is the same. So from physics, we know that it falls at the same rate, but the distance that it falls is increasing. And that's what's happening here. And so when we finally get up here to the red line, to this very steep angle, now look at that. See, now it looks like we've got a whole bunch of that shadow that has just bled away. And finally, when we go from the red to the gray, look at that. The whole thing almost instantly, in the same interval of time, now shrinks to nothing. So what happens is that when you are looking at things that should be in two different scales, but you're looking at it on a clock scale, a calendar, let's say 1 day, 2 day, 3 days are passing, it looks like it's accelerating. So if you were measuring time on this scale, we're measuring time as the rate at which that shadow is diminishing, it looks like time is picking up or that it's moving quicker. And we already said from the definition here that is simply not true. So as I said before, it's a very difficult concept to teach options traders that when you are moving through time in calendar space, let's say 30 days to expiration, 29, 28, and so on, equally spaced days, it makes it appear that your option is decaying faster. But it's really because the option is following this square root of time rule, and your calendar is looking at time. They're just two different scales. So again, I know it can be confusing, but let's go over to an Excel spreadsheet and see if it sheds some more light on the subject. Okay, so now we're into an Excel spreadsheet, and I've got 100 days to expiration. This is what we saw in the presentation, all the way down to 0. And then up here at the top, we're going to say that the amount of time remaining as a percentage is 100%. So if it's a 100-day option and we have 100 days, it's got 100% of the time remaining. 1 day later, when there's 99 days remaining, we have 0.99 of the time remaining. In this column, we're going to take the square root of time because this is the key. This is how option prices actually move. So here we can make the options price anything we want. This is what I did in the presentation. I made it $1. So after 1 day, it would be worth 0.995 or 99.5 cents. On this third day here, it would be worth 99 cents and so on. If we want to make it a $5 option, still decays at the same, at least the same proportions according to the square root of time. I'm going to take it back to 1 for right now. So now the time decay multiple, I've talked about this in previous videos. If we take 1 divided by the square root of time, we've got 1 divided by 1 or 1. Whatever the time decay is, or the theta, is just that number. But let's come down here to, let's say, 25 days to expiration. And we see that with 25 days remaining. Square root of a quarter is a half. We talked about that. And the options price would be in half. It would be trading for 50 cents. So what's your time decay multiple now? Well, if we take 1 divided by a half, it becomes 2. So now your theta appears to be twice as big. If we were going to lose 1 cent in one day at the beginning, we're now going to lose 2 cents. That's all that means. But notice what we're doing, what's causing this distortion, is we're still counting time in increments of 1. So what happens if we use our typical time decay curve, which is days, calendar days, and the options price? Yes, we get this kind of scary curvature down here. We start looking at this around the 25% mark and say, uh-oh, my option's about to go off a steep cliff. But it's really an illusion, because if we look at the actual slope, we'll find that it stays roughly the same. Now, I said earlier, it looks like this is a fairly gentle slope and then very steep down here. But watch what happens. Let's take the slope of the curve, and how do we do that? In algebra, we're going to take, remember, rise over run. So let's take the time. We'll take 99 divided by 100, and then we're going to take 1 minus that number to say that we have lost 1%. Isn't that true? Starting with 100 days, we drop to 99 days, we've lost 1% of the time. That's what that is. Now we're going to say what happened to the options price. Well, it goes from $1 to 0.995, so if we divide these out, we get that number, we take 1 minus that number, we get 0.005. So what's the slope here? We're going to take that number divided by that number, and it's roughly a half. So the slope right here, the mathematical slope in this very tiny area, is a half. Now over here, obviously, visually, this is much steeper. We should get a number much bigger than a half. So let's go down here. Let's go down to a quarter. All right, so let's do the same calculation right here with time. So rather than copying the formulas down, I'm just going to repeat them so you can see what's going on. We're going from 25 days to 24. And if we say 1 minus that, that is a loss of 4% of the time. See, that's the difference. In a regular time decay graph, we see it as 1 day, but it's 4% of the time. What happened to the options price? Well, the options price goes from 50 cents to 49 cents right there. So we divide those out. I say 1 minus that. We've lost 2%. So check this out. You can already see it. If I say equals that number divided by that one, it's basically a half. See, it's an illusion that it looks like that slope is getting steeper because we're putting it in this distorted lens of keeping time changing by 1 unit instead of the square root of time. So it's not getting steeper. It's just that we're looking at it again in calendar time for something that moves according to the square root of time. So what would happen if we put time according to the square root? And that's what I've done over here. And if we graph them, look at that. Perfectly straight line. You see, the slope is actually the same if we look at things in options trading, what we call volatility time, a little bit more of a mathematical concept. If we look at them in volatility time, that slope is exactly the same every single step of the way. When we experience this idea of time decay, especially on our graph, what's really happening is we're seeing the bell curve starting to pinch in. And that happens to be at a constant rate. But because, if we go to a bell curve here, watch what happens. Let's say we've got 20% volatility, and I'm going to make this 12 months. We'll make this 12 months as well. And it's a little weird in Excel how you have to do this, but if this is 0.2% for volatility, then 3 standard deviations would be 3 times that, or minus 0.6. So this is our minus 3 standard deviations out here. So if this is a 1-year option, 12 months to expiration, 20% below, or 1 standard deviation below, let's say on a $100 stock, would be $80. So let's put this marker here, this black marker at minus 0.2, we're saying what's the probability that the stock lands in this left tail. So maybe this is a put option strike. Now watch what happens when we go to 11 months. You can see that the change in that bell curve from the red to the blue wasn't all that great. Didn't really reduce this area. In other words, it's not going to make a big difference in your options price. We go to 10 months. What happens? See, now we're starting to see bigger changes. And we get bigger changes, and then we go to 8 months, and we start seeing even bigger changes. Let's knock it down to 4 months. Look at that. See, now we're starting to see bigger and bigger changes. So I'm going to bring this to 4 months so we can compare from this point in. Let's go from 4 to 3. Look at the change in that. That's a whole lot bigger. It's still in proportion, but it's because we've got this kind of this upward slope right here in our bell curve. In fact, if you were to take this curve and flip it over, that's basically where your time decay curve is coming from. It's this contraction of your bell curve. It's the probability of exceeding that strike that's quickly dropping. So let's go to 2 months. Look at that. And now if we go to 1 month, you can see that that option is basically worthless. The model is now saying there's virtually no chance, just by probability alone, that the stock will be to the left of that black line. Well, let's go to a pricing model and see if this is actually true. Okay, so now we're into a pricing model, and let's use the same example that I just did. We're going to start out with the stock and strike at 100, 1 year to expiration, 20% volatility, and let's use the put option priced at 791. And notice that the theta is minus 0.01. So one of the things that we found from the spreadsheet is that if I make time 25% of the time remaining, or 90 days, this should go to 2. We should double. Let's try it and see if that's true. Let's make that 90 and watch that. Goes to exactly 2. See, so the illusion is that the slope is starting to change, that it's starting to decay faster. But once again, that's really an illusion because we're looking at it through this distorted lens. Square root of time versus actual time and calendar time. So let's go try this out in what we did in the presentation. We did 1 year, and we said that we were looking at 1 standard deviation down with a put. So that would be an 80 strike put. And if we do that, it says the put is worth $1.16. Now remember, as we slid down there, we went from 4 months to 3 to 2, and when we hit 1 month, we saw that bell curve completely collapse. And we should go worthless if our models are correct. So let's try it. Let's come down here to maybe 3 months. We'll go to 90 days. Look at that, starting to collapse pretty close to 0. Let's go to 60 days. That's only 2 months. Still a little bit of time. That's what we saw in the Excel sheet. And then what happened when we went to 30 days? It completely went flat. So we should get exactly 0 right there. And there you go. See, it's really this idea that the bell curve is collapsing. Theta doesn't exist in a vacuum by itself. It's a reflection of gamma. It's a reflection of that bell curve. And if you're not taking that into account, you're going to make very bad decisions. Because people say, oh, I need to do this because of theta, or I need to sell options because of theta. And they're not recognizing it's a result of gamma. So the thing to take from this is you have to think about volatility time, which would be thinking about your calendar in the square root of time. And option prices live in this world that we call volatility time. And in that world, decay is equal and smooth. Theta, again, is a price of gamma. So one of the main things to take from this is that theta doesn't add risk. What it does, and this is critical, it defines the trade-off between time and gamma. So don't close a position just because of time or just because of this unwarranted fear of theta. You want to close because of a belief that the future movement or the volatility will not be big enough to compensate you for the time. That has always been the decision every single step of the way, every single day, even though it appears to accelerate as time goes on. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.